My name is Pule Taukobong. I'm the chairman of Africa Angels Network, and you're watching AFK Insider. In terms of risk analysis in this space, having come from a stockbroking and a wealth management background, that industry itself is very much documented, especially when it's listed equities or large private equity space. But I don't think we can do the same amount of analysis when we look at these startups. So I use something which is based on 5 key factors. I look at the team, and the team is not just the individuals running the business, it's also who do they have advisors, do they have the right people that have industry-related skills? If not, can we plug them into our network? The second point is the product. I've got to believe in the actual product. That's the third point, the market needs the product, because market background and market understanding is very important to see if they can grow the business and there's demand for it. So that's very important. And then the fourth point is traction. Like, is this something that's already started to take off? And is there room for it to scale further? And then the fifth point is my gut feel. So that's my risk analysis in this space. There's various, it goes more in depth in each of the 5, but the key 5 is definitely team, product, market, traction, gut feel. So when it comes to scouting businesses, what really tickles my fancy, I'm very much I believe in people. You know, that's why it's always in that order that I mentioned: team, product, market, traction. Those points are very key, and gut feel. I've got to know and believe that the entrepreneurs I'm working with and investing in can do what they say they want to do. So you've got to put that across, that you understand this in depth, you have the skill set amongst your team to execute this, and you're going to make it a successful business. That's very important. But the key thing is, we're not a passive investor. We're very much involved in the business building of these businesses. So that can see, as you've invested, are these guys growing? Is it coming together? But the benefit of doing such is that we have a sector approach of which sectors we invest in. We also understand those industries pretty much in depth. So when we look back at someone coming to pitch a video streaming website, for example, we've been working with companies in that sector, and we can see if their skill set, if their market understanding makes sense, and that they actually can grow the business, or they've identified something that's unique in the space. And we have a portfolio approach. So sometimes we look at startups that are doing similar things and say, actually, you guys should be working together. You could create a magnificent product. So it's not looking at each business in a silo approach. So what should they understand in terms of they raising capital as a business? What do they need to give up? It varies, depending on which stage you're on, because the continent's a very interesting landscape. Because of the lack of access to early stage funding, some startups tend to go for 2 to 3 years. So until they actually meet someone who's going to give them capital. So how much equity they're going to give away at that time is dependent on how much income are they making. Is this just an idea or a concept, or something that's generating revenue? Do they want to do it in the form of equity? Do they want to do it in the form of convertible note? I think it's very scenario dependent, and that's where they need to call on mentors and a team that can help them, advise them to say, in terms of, this is the stage you're at, this is how much you should be prepared to give away from equity, because we all need to be realistic. It's tough to get angels on the continent. As I said, there's not that many, and what that does is that the very few angels are seeing a lot of deals. So we've got to be seeing, how do you offer them something that's competitive, and also understanding the angel network that you're going to be work with, of what can they bring to you or for you to the table. So typically a startup, I believe, should be raising capital that would keep them going for at least 18 months. Because again, the taps of capital are so tight, you don't want to have to do it more than once in a very short space of time. So you want to know, I've raised X amount, this is going to keep me going for 18 months based on our burn rate, and feel confident with that. So that's the minimum I would say you should be raising. And then, as discussed from an equity perspective, how much you give away is debatable on where the business is at that time. So our industries are tech and design. So by tech, I mean technology companies, which include media, entertainment, education technology, mapping technology, trade tech, and by trade tech I mean technology that helps intra-African trade happen on a larger scale. Design, I mean fashion brands. So we've invested in a high-end sneaker manufacturer out of Ethiopia called NZ Footwear that makes pretty cool sneakers. But the key is that they meet those 5 factors that I was mentioning about earlier: great scalability, good product, brilliant team that understands the market and already has traction.